Heiken Ashi charts are becoming more and more popular among traders, and there are many trading strategies built around this type of charts. Heiken Ashi is a modified candlestick charting technique that rearranges how the price is displayed. Basically, Heiken Ashi charts make candlestick charts more readable for traders who want to know when to stay in a trade and ride a strong trend, and when to get out when the trend weakens. Although Heiken Ashi has many advantages, a lot of traders prefer to analyze classic candlestick charts. But what if you could combine both charts in order to have the classic candles and still be able to plot Heiken Ashi candles? We can do that by using smoothed Heiken Ashi candles. In today's video, we'll take a look at the Heiken Ashi smoothed indicator, and I'll show you how you can apply this tool and configure it to your preference. Before going further, let's refresh our memory with how the Heiken Ashi chart plots prices and how traders use this type of chart when analyzing the price of an asset. Candles on traditional Japanese candlestick charts frequently change their color, which can make them difficult to read. On the other hand, candles on the Heiken Ashi chart display more consecutive colored candles, helping traders to identify past price movements more easily. You'll notice that Heiken Ashi charts have a tendency for its candles to stay green during an uptrend and stay red during a downtrend. This is in contrast to traditional Japanese candlesticks that alternate color even if the price is moving strongly in one direction. A Heiken Ashi chart is much smoother looking in terms of price action. This is why many traders prefer to use the Heiken Ashi candles, since it reduces the noise on the chart and allows them to analyze trends more clearly. What makes Heiken Ashi different from a traditional Japanese candlestick chart is how the price is displayed in terms of the open and the close. If you look closely at the Heiken Ashi chart, you'll notice that each of the Heiken Ashi candlesticks start from the middle of the candlestick before it, and not from the level where the previous candlestick had closed. While Japanese candlesticks require many definitions and flexible rules for most patterns, a Heiken Ashi chart works with only 5 simple rules. A sequence of green bodies identifies an uptrend, while a sequence of red bodies identifies a downtrend. The uptrend gets stronger with longer green bodies and no lower shadows. The downtrend gets stronger with longer red bodies and no upper shadows. The trend gets weaker with smaller bodies and with the emergence of lower and upper shadows. A consolidation is revealed when you spot a series of smaller bodies with both upper and lower shadows. And finally, a trend reversal could follow when you spot multiple candles with small bodies and long upper and lower shadows, or a sudden color change. Just like any other tool used for technical analysis, Heiken Ashi is useful, but it does have some weaknesses or limitations. While the traditional Japanese candlesticks are derived from the actual prices, Heiken Ashi candlesticks are not. Because the Heiken Ashi candlesticks are averaged, they don't show the exact open and close prices for a particular time period. Heiken Ashi charts obscure actual price information. The closing price is considered important for many traders, but the closing price is not displayed on a Heiken Ashi candlestick. We can fix this problem by using the smoothed Heiken Ashi indicator. Smoothed Heiken Ashi is a modified version of the regular Heiken Ashi candlestick charts. While you can typically use the regular Heiken Ashi chart all by itself, the Heiken Ashi smoothed indicator is used as an overlay on the regular candlestick chart. If you have a TradingView account, this is the exact version I use. As you can see, you'll get a better perspective of the markets. You can see the regular candlestick chart alongside the Heiken Ashi smoothed indicator. This is not possible if you use the regular Heiken Ashi chart. The main difference between the regular Heiken Ashi and the Heiken Ashi smoothed indicator is that the second one plots the Heiken Ashi candlesticks as a moving average. The general rule of thumb is that the markets are in an uptrend when the smoothed Heiken Ashi indicator is bullish or green, and the markets are in a downtrend when the smoothed Heiken Ashi indicator is bearish or red. Smoothed Heiken Ashi is a trend following indicator. In uptrends, price tends to stay above it. In downtrends, price typically stays below the smoothed Heiken Ashi. The first possibility of a change in trend is when the price crosses through the indicator. Downtrends start to reverse when price crosses back up and through the smoothed Heiken Ashi, while uptrends show signs of reversal when price falls through the smoothed Heiken Ashi below it. The settings for the smoothed Heiken Ashi indicator are very simple. You can set the values of the two moving averages that are used. Depending on your trading style, scalping, day trading or swing trading, you can change the value of the indicator to suit your trading needs. Here are several settings you could try. First one, the 5-period smoothed Heiken Ashi. This is suited to scalping techniques, tracking the strong momentum and the trend in the short term. The 5-period smoothed Heiken Ashi acts as a support in the strongest trends. This line is best used in low volatility trends with strong momentum. You can also use it as a trailing stop. The 10-period smoothed Heiken Ashi, which is the default value, is a great method to keep you on the right side of the major market trends. It is usually the first line to be lost before any real trouble begins, meaning any reversals in a current trend. From my backtesting, it can be used as a standalone signal in some stocks and markets that tend to trend strongly in one direction for long periods. The 20-period smoothed Heiken Ashi acts like an intermediate term moving average. It's generally the last line of support in a volatile uptrend. To me, it's the reversion to the mean in a market when it finally pulls back after an extended trend. 50-period smoothed Heiken Ashi is the line that strong leading stocks typically pull back to. This is usually the main support level for strong uptrends. Most bull markets and uptrends will usually pull back to this level. From my backtesting, the 50-period smoothed Heiken Ashi is generally a great buy the dip level. If you enjoy swing trading or position trading, you can use the 100-period smoothed Heiken Ashi, which indicate long-term direction. This is the deeper pullback level in a bull market and uptrends. It usually presents a great risk-to-reward ratio in bull markets. Now, how to use smoothed Heiken Ashi? There are three main ways in which you can use it: to determine the direction of the trend, to determine support and resistance levels, and using multiple smoothed Heiken Ashi for long and short-term market trends. First approach is to determine the direction of the trend. When prices are trending higher, the smoothed Heiken Ashi will adjust by also moving higher to reflect the increasing prices. This could be explained as a bullish signal where traders may prefer buying opportunities. The opposite would be true if the price was consistently trading below the smoothed Heiken Ashi indicator, where traders would then prefer selling opportunities due to the market signaling a downward trend. Second approach is using smoothed Heiken Ashi for support and resistance levels. If you see the smoothed Heiken Ashi trending higher, you could enter the market on a retest of the smoothed Heiken Ashi level. Likewise, when you are long in an uptrend market, then the smoothed Heiken Ashi can be used as a stop-loss level. The opposite is true for downtrends. In this chart, you can see several examples of how the smoothed Heiken Ashi can be used as a powerful level of support or resistance. Third approach is making use of multiple smoothed Heiken Ashi. This allows traders to simultaneously assess the short and long-term trends in the market. As price crosses above or below these plotted levels on the graph, it can be explained as either strength or weakness for the asset you are trading. This method of using more than one smoothed Heiken Ashi can be extremely useful in trending markets. Now, very important, when making use of multiple smoothed Heiken Ashi, you might have the idea to trade when the lines will cross. A bullish cross is identified when the short-term smoothed Heiken Ashi crosses above the long-term smoothed Heiken Ashi, while a bearish cross represents the short-term smoothed Heiken Ashi crossing below the long-term smoothed Heiken Ashi. Don't use this strategy. Heiken Ashi is considered a lagging indicator that not only dismisses useless signals to open the trade, but also provide you with a late signal for closing the trade. Attempting to build a crossover strategy with two smoothed Heiken Ashi lines is a very bad idea. If you don't want to see the market slowly destroying your profit, as the trend you are trying to trade has already changed, I advise you to use multiple smoothed Heiken Ashi lines only for dynamic support and resistance levels, and not for crossover signals. Every Heiken Ashi trading system should include price action rules, so look for support and resistance levels, look for chart patterns for potential breakouts, and try to enter into emerging trends and exit on slowing trends. Also, as you are able to see the classic candlesticks, you can combine classic price action with smoothed Heiken Ashi. You will be able to identify a pin bar, an engulfing candle, or a reversal pattern, and at the same time knowing what Heiken Ashi are indicating. With classic candlesticks, an engulfing candlestick pattern at a support level can be a nice starting signal, a decent entry into a beginning upward movement. Nevertheless, there is room for misinterpretation. With additional smoothed Heiken Ashi candles on the same chart, you can mitigate this danger of misinterpretation, and it can help you to judge a trend more clearly in combination with the classic candlesticks. That's why it's better to use both candle types on the same chart. Despite the simplicity of the Heiken Ashi approach, you must be aware that Heiken Ashi candles, unlike classic candlesticks, are in fact indicators. This is due to the construction of the Heiken Ashi candles, in which the current and previous periods are always considered. So the Heiken Ashi candles are not the ultimate trading instrument. That's why the combination between the classic candlesticks and the Heiken Ashi represents a better and a safer approach to trade. You analyze the markets with a classic candlestick chart, and you apply the smoothed Heiken Ashi to filter against false signals. As always, if you learned something new and found value, leave us a like to show our support, subscribe to our channel and hit the bell icon to stay notified when we upload new videos. Until next time.